Oil prices are still rising. Every time we turn around, they're going up, they're going down, bigly, crazily, all over the place, right? How can you develop a trading plan to work around this? Well, I got to tell you, because of the volatility of this, you need to really pull back your position sizing. That would be the very first thing I would start with. Now, what is this down here? This is what's called the ATR. ATR is measuring the volatility of a stock. Now, this can change day to day, week to week, and stock to stock, of course. But the volatility of oil, this is the oil futures contracts, was around $1.86 before everything happened in Iran. Now the volatility is around 753. So let's divide, right? 753 divided by 186 means it's 4 times more risk. 4 times more risk, which means you need to be trading at one fourth the amount of position size that you were trading before in order to make sure that you're not getting crushed by these moves. Because listen, as exciting as this is to be a part of a big, beautiful uptrend, it is not super exciting to buy it right up here. And somebody did. That's how that price printed right there. Somebody bought it at $119 a barrel. Somebody also bought it on the exact same day at $81 a barrel, right? When you are trading, you want to minimize risk at all times. Well, I know. The internet thinks that I'm crazy. Oh, no, you're so stupid. Don't you understand? You want to maximize returns, not minimize risk. No. The math behind it is you want to maximize your returns by minimizing risk. Well, how does that work? Right? Let's say that we took a look at this exact candle right here. This one big giant candle, right? That had a 30% move down from top to bottom. I wonder what the math would be for it to go back up, right? If you were to start at the bottom and go to the top versus start at the top to go to the bottom. A 31% down move top to bottom. Do you think it's 31.7% up? It's not. It's not. In fact, this move here back up is 46%. Wait, what? That's not possible. It's exactly the math behind it, right? Exactly the math behind it. So that's why I'm trying to tell you guys, you want to trade smaller when the volatility is higher. Now, how do we calculate this? So this is my position sizing formula. You take your account balance times your risk percent and you divide by the 2 ATR. So let's pull out the calculator here. Let's pull out the Excel and let's look at it together, right? So let's say that you have a $50,000 account and let's say you want to risk 5%, right? We'll use even round numbers here. Yeah, these are even. You're welcome. And they are round as well. And let's say that the ATR value was $1.86. Okay. So in this first example, we take your account balance. Let me type in $1.86 ATR 186. There we go. You take your account balance times the risk you're willing to take, and you divide that by the ATR. That gives you this much is how much you're risking to your portfolio in this case. All right. Or I should say how many shares you're risking. Right. Did I get that right? Hang on, let me double check that. Number of shares. Yeah. So you would need to take a position of 1344 shares. Okay. Let's push this in. There we go. 1344 shares. Now, let's say you have $50,000. You're still taking 5% risk. And the ATR is now at, what was it, 750? 755? 755. So this exact formula here, and this is number of shares, you would end up with 331 shares. 331 shares. Now, why is that? Because you're still getting the exact same risk in dollars for 4 times less shares. 4 times more shares versus 4 times less shares. Give or take, right? We're rounding here. But the point here is that anytime volatility is expanded, you want to pull in your position size. You want to be trading the largest when volatility is small. And you want to be trading the smallest when volatility is big. Now, again, to reiterate the point of minimizing your losses, what does that look like? I have a slide for this. This, right? A 10% loss requires an 11% gain to get back to break even. 20% loss, 25% gain to get back to break even. 50% loss requires a 100% gain to get back to break even. This is where people's brains break, right? Wait, what do you mean a 50% decline needs a 100% gain, right? Let's go to PayPal. There's all kinds of jokers who would tell you PayPal is such a great stock. All kinds of jokers who would tell you it's the best stock you've ever seen, right? But let's figure out just exactly how far down it's gone, right? From this peak right here to today, it's down 52.05%. It was right around $93, and today it's around $44. That's a 52% decline. In order to get back to all-time highs, this has to go up 112%. Math is weird like that. Math is weird like that. Now, your portfolio will have the same thing happen to it. If you let your portfolio go down 52%, you need a 112% gain on what's left to get back to where you were. That's the point I'm trying to get across here. As exciting as the big gains are, the losses work against you geometrically more. So why do we care about that? Why do we care about the risk? So if I pull up my back-tested data here, I know that my average loss in this case is 4.41% on my trading plan. Now, if I can keep my average risk to be at this or less, then I'm going to get closer to my expectancy. Well, let's say that we keep our winners and let them run as far as they can, and then they achieve the average win, which is 7.27% or more. So you want to get to this number or less, and this number or more. What do you think would happen to your expectancy? It would grow. It would expand. You would have greater profitability. So it's not all about getting the most that you can. In reality, to be a successful trader, it's about minimizing those losses. And if you're trading oil right now, you've got to figure out a way to keep your risk in check, because this is a very, very volatile market. And I would say the easiest way to do that is by trading a smaller size. Yes, you're going to make less money than you would if you trade a bigger size, but it's being offset by the fact that it's more volatile. So you can make the same amount of money as 1,344 shares as you would on only 331 shares. Does that make sense? Type a thumbs up in the chat if that makes sense. You can make the same amount of gains. You can make the same amount of gains on 331 shares versus 1,344, but you can take significantly less risk to your portfolio. All right, cool. Let's move on. Lots of questions coming through today, and I don't have a lot of time, so I got to breeze through these as fast as I can. Can you please explain the 2 ATR stop? Why 2 ATR instead of 1? The answer, the short answer, the fast answer is that this had a greater expectancy by giving it a 2 ATR stop out point than a 1 ATR stop out point. Now, keep in mind, this feeds into the expectancy here, right? This is built on that. Now, a couple other notes here, really interesting notes in my opinion. The average trade ATR for winners goes up 2.21. The average trade ATR for losers goes down 1.38. So even though this is our stop out point on losers, the average trade ATR to close it is at 1.38. Which actually shows over here as well, the 1.38. So that is the answer. I wish I could give you more, like what would happen at 1, but I mean, we didn't keep that data because it didn't matter in this case. Do you find anything besides SGov as a good option? There's all kinds of different options out there for places to put your your cash on the sidelines. SCH, well, granted, I'm not endorsing any of these. The only one that I use is SGov. Do your own research, find if that works for you. SCHD is not one of those, by the way. SCHD is not at all. SCHD has market risk. You want to see the difference between SGov, which moves up, down, up, down. The reason being is that this is the dividend going to your account as if it were going up in value each day. When the dividend is actually paid, it goes down by the amount of the dividend and then comes back up. You're not losing any money. You're getting cash back into your account. But if you withdraw during the month at any time, you get to keep that cash ahead of time, okay? Versus SCHD. SCHD. This has market risk, right? Now you're looking at this and you're like, wow, that looks great. That looks great, right? But there is also market risk associated with this. This is not a as close to risk-free asset as possible. And when we're in cash, that is what I'm looking for. You said those interviews are invitation only. Okay, we already talked about that. What are you looking forward to most on spring break? I don't know, just hanging out, doing whatever. What is the best way to use the 10, 20, 50 for day trading? And also, what about Chris chain stickers? First off, I love the idea of Chris chain stickers. But the 10, 20, 50 is the way to go, right? Now, granted, you can use this on any time frame, right? Let's go to SPY, and let's go to, this is the daily chart, right? This is the daily chart. And what I want to do is get real fancy here for a second. Let's put on 4 different setups here. All right, I want SPY on all 4. And this is the 5-minute chart. Let's put SPY over here. This is the weekly chart. And let's put SPY over here. And this is the 1-minute chart. Okay, so cool, 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 and cool. All right, so looking at these 4, all 4 of these are SPY. All 4 of them are. This is the daily. This is the weekly. This is the 5-minute. This is the 1-minute. The 10, 20, 50 works on all periods because it's just math. The 10 under the 20, price under the 50 is showing you the direction is down. Now, I can't tell you duration nor magnitude, and I'm not the YouTube guru who's going to try and tell you they know the future, but we can see the direction, right? It's like saying you can drive from Dallas to Disney World. You're going to get there, right? If you turn east and you head towards Florida, you're going to get there eventually. But I can't tell you how long it's going to take, and I can't tell you the magnitude of getting there. I don't know. That's a weird question. I can't tell you how long in time nor how fast you can go. There you go. That's the answer. But I can tell you you're going in that direction. Now, that doesn't mean it lasts forever either, right? Of course, this can change, right? We had a couple spots in the last few months where it kind of went both ways and then turned around. So when you're using the 10, 20, 50, it always works, right? But look at it from different time frames. From a weekly time frame, this is still a bullish trend. Your 10 is over the 20, price is over the 50. On a daily time frame, this is a bearish trend. On a 5-minute time frame, this is a bearish trend. And on a 1-minute time frame, this is a bearish trend. This is what's called looking at it from different time frame, multi-timeframe analysis. And so if you are a day trader, this might be the way that you'd want to look, is have all 4 in confluence, right? And you don't really have that quite yet on the weekly. But then again, I'm not a day trader. I don't claim to be one on the internet, and I don't want to be. It is not for me. Rick, the interview last night. So the interview was with Victor Nealon. By the time you're watching the replay of this, you'll see Victor's interview over in our Champion Trader playlist series. Let me show you that real quick. Let me pull up YouTube. Hold tight 2 seconds here. I have a Stream Deck button for that. All right, so Victor's interview will be part of the Champion Traders playlist, so you definitely want to go watch that. So Rick was saying the interview last night was really good. I really resonated with his idea of selling half your position. It's something I've been doing as soon as that sell signal comes, rather than waiting till the end of day. There you go. That makes sense. Now, Minervini also has a similar rule. In fact, you can see me and him talking about that specifically in the Market Wizards playlist. And I don't know which one of these it's in, but talking about selling half of your position versus a third or anything else. Because if you sell half, there's a psychological benefit there because you're like, if it goes up, you're like, oh man, well, at least I only sold half. If it's any more, any less, you're going to feel weird about it. Let's say if it goes down, you're like, and you sold half, you're like, oh man, at least I only, got out of half and I'm only holding half of it as it goes down versus anything other than that. So yeah, dude. And you'll always hear me say this, figure out a plan that works for you. Any changes in the pipeline for trading play? So I'm holding cash. I don't know how long I'm going to hold cash, and I'm not going to claim to know how long I'm going to hold cash. In fact, I'm going to hold cash. Where's the slide? Here. I'm going to wait in cash for proper setups. How long? As long as it takes. Now, I will tell you one thing. There are some stocks. AAOI is an example. This is one from Shane the Plumber. Shane the Plumber is a rock star. I'm really excited about Shane. In fact, I've got some ideas I want to throw at Shane. This is a fantastic trade that I didn't take, and I'm not claiming that I did. But also, this guy here, John Zachary, gave me some ideas. One of those is if a stock breaks out above this Keltner channel range. Now, a Keltner channel is measuring one ATR value. We talked about what ATRs are. That's your volatility. and he's using a 13 period as his moving average. So one ATR above 13 and one ATR above the 13. And actually, this is pretty cool. Actually, you can see how ATR was small down here, how it's expanded. And you can see how this ATR envelope with the Keltner channels was really tight, a little bit wider, and now it's getting even wider. There you go. That's a great example of what that looks like. I really think that we are going to set a new strategy. Now, granted, don't rush me into this. Listen, let me take my time to backtest this and prove that it works. All right. I don't want to hear this every other day. Is the new strategy ready? Is the new strategy ready? Is the new strategy ready? As a professional investor, I will take as long as I need to make sure that I'm comfortable putting money at risk in the market. Okay. So don't bother me about it. But while we're backtesting, I'll show it to you as we do it live. My theory is if we can combine part of the Outlier 9 with these stocks that are popping out of these Keltner channel ranges, and they're running like crazy while sitting cash and not F up is active, these could be really interesting plays. These could be really interesting plays. So that's probably what the next pipeline is going to be for me, at least. Outlier continues to get better. Can you please remind people how much it is? Well, you know what? It's only 82 cents a day. Yeah, 82 cents a day gets you access, the full access to Outlier. There are no upsells. You get access to the Discord. You get access to the trading plans. You get access to my actual trades that I'm putting on in the US Investing Championship, and I'm currently ranked 27th in the world. I don't know why they call it the US Investing Championship. It's the World Trading Championship, right? Ranked 27th in the world in our division. So yeah, totally up to you. You do you. I don't care what you do. But Outlier is only 82 cents a day. Archangel has a question. Can you talk about calculating the new bid-ask spread rule? Okay, so I worked with Cam, one of our outliers, and came up with a new rule around the bid and ask spread. And I really appreciate Cam, because Cam and I worked together for a couple of weeks to make sure that that these rules were really solid, and I'm very excited about it. So this is my options liquidity criteria now. And again, this plan is linked down below. You're welcome to have it for free. We're looking at monthly contracts, at least 30 days until expiration. So monthly contracts, you would come up into Tradier and change to expirations, regular expirations. So I'm only looking at monthly contracts, and I'm only looking 30 days plus until expiration. Why 30 days? So my average trade duration, based on my back testing here, is roughly 17 days. Where's that at? Here, 17.46 days. So I don't want as much decay as possible in that case. I want to have as little decay as possible. And this is one of the enhancements and improvements in the plan, because I was going 21 days or greater. And if I'm holding for 17 days, that means like all of the extrinsic value could work against me. So looking at this, the bid and ask spread 30 days out plus 200 plus open interest at the chosen strike. What does that mean? So looking at this, it's really easy. There's lots of liquidity here, right? Let's go to something that may not be as liquid, maybe SoFi. There we go. A great example. Okay. I wouldn't be interested in trading anything until it has at least 200 on the open interest. So nothing above. And then at least 200 all the way down. What does that mean? I want to be able to roll these. At some point, rolling them means buying or closing one and moving to the next one down. Closing one and moving to the next one down. And by doing so, I'm taking partial profits, I'm freeing up capital, and I'm keeping the trade alive. So this would be a great example. I would go with a 91 or less. 91 or less, okay? Or I should say 91 or down. Because all of these have enough liquidity. Let's go to a different one, like Texas Roadhouse, TXRH. Nobody's here. Literally no one's here. Let's go to Ford. Right? Again, nobody's here. I wouldn't trade this. Now, out of the money, there's definitely some interest, but that's not going to work for me. What about Microsoft? Oh yeah, tons of open interest. So I'm looking for 200. So I would start here. I wouldn't go with these. I mean, you could go with this, but then if you're rolling to the next ones, you couldn't really get there. Now, I would call that Charlotte's rule. I'm going to call this Charlotte's rule, because Charlotte, one of our Bravo students, actually had this thought, and it was really, really intelligent. So I'm definitely going to use that. Next, the bid and ask spread. How do we calculate that? Now, granted, this involves math. This involves math. But you know what this is? This is the greatest job in the world. And if you can't take the time to do an itty bitty baby bit of math, maybe trading's not right for you. maybe investing in the stock market is not the right place for you. But let's say that you can do math, okay? I'll show you the exact math. But listen, I'm prefacing this by saying, oh, there's too much work. I can't do all that. Ugh. Then don't do it. If you can't do it, don't do it. If you can't do it, just don't do it. All right. So let's say, for example, that I'm going to get the 78 delta with 528 contracts. Remember, it's good all the way down. Okay. Now, historically, this would be one I would not take. And this is a great example because this is over $2 wide. $2 wide is quite a bit, right? But how much is that really? So if we take 37.75, which is the amount that in theory we'd have to buy it for, and 35.50, we subtract one for the other. That gets us to 225. 225 is what's called the bid and ask spread. Now, $2.25 kind of sucks. That's kind of a bit, right? In theory, if you think about it, right? If you were to buy this, it cost you $3,700 per contract, and you'd sell it back for $3,500 a contract, meaning you take a $225 bath per contract. Ugh, I don't like that. However, what is that in actual terms of percentage, right? So it's new minus old, in this case, ask minus bid divided by ask. So 37.75. That's only a 5.9% spread. So the formula is ask minus bid divided by ask. Ask minus bid divided by ask. And we want it to be less than a 10% spread. A less than a 10% spread. So that's how you would get to that. And that one I would be interested in taking. If Microsoft were set up from a perspective that I was interested in taking the risk on the trade, it has enough liquidity. It has a bid and ask spread that's tight enough in this case. And most likely, I could probably find somewhere in the mid. I could probably find somewhere between these 2 points. So I wouldn't have to go all the way to either side. I'm already running behind. So I'm gonna blaze through these as fast as I possibly can. Plan M, you have an exit on earnings. How do you close for earnings release? Do you still trade for both the entry and exit? So if a stock has earnings, I will trade it up to the earnings point, and then I will get out the day earnings happen, if it's in the afternoon, or the night or the day before if they happen in that morning. Now, if there's still a buy signal, or maybe even a buy signal comes later on, I would be interested in picking that up the next day. But it really depends on the timing around that. Would a strategy for buying put options be inverted approach to buying calls on plan M? Maybe plan W. I love the idea of flipping plan M on its head and calling it plan W. The problem, the expectancy is really bad. We actually did backtest exactly plan M flipped on its head to find you a short strategy, and it is not. Do not try it. Do not try it. We will eventually have short signals. And granted, you do whatever you want, but I'm telling you, the expectancy was to a point where I wasn't willing to put my money at risk. Are the performance summary sections on the dashboard it updates daily? I believe it does. Now, granted, Outlier is doing an upgrade right now, so I don't know if this is going to show. Let's refresh this real quick. No, the upgrade is still happening right now. Performance summary might show. Okay, it does. As far as I understand, this does update on a daily basis. What does that mean? If a buy signal is active, like it is right now, then every day that ticks by, this should be updating. Should be. I could be wrong, but I believe that's the case. Outlier support is amazing. I agree. Thank you for that. Any specific trade ideas for Friday the 13th? Yeah, hold cash. That's my trade idea. Can you expand how to use Keltner channels that might help on trades? So I would definitely go watch this video from John Zachary. But in a nutshell, this is his strategy, not mine. I do not endorse this yet. If it closes above the Keltner channel, and then the entire candle, the next candle is entirely above the Keltner channel, that would be an entry point. At least that's how I'm interpreting it. So first to close above, and then waiting for a confirmation where the entire candle is above it, then getting in and letting that rip. I am not endorsing this. I have not back tested this. This is from what my understanding is, and I'm not going to give you an exit point because I don't know where that would be. Will Joe take over live streams? Good. I like it. Let's work for me. Let's do it. News about the trading deal. I don't know what that means. I don't know what that means. The Did you know that a visual strategy builder is being built for Outlier? It's now in beta testing. There you go. We are working on a back testing tool. Mostly Deep Thought's working on a back testing tool because he has that supercomputer brain. I'm very excited about that. What do I think about changing the exit signal? I'm not changing mine. Reason being is that we back tested them, right? I have all the data that I need to support why I have these exit signals, and I'm going to continue to hold them. If you choose a different exit signal, that's fine. That's totally fine. Go with whatever exit signals work for you, but I will not be changing mine. I will not be changing mine because then we no longer have plan M. We have something completely different. And I would also caution you, if you're going to start changing signals, this is a permanent change. You don't get to change signals on Monday and then change them on Wednesday and then change them back on Friday. When you make the change, you make the change globally because you should have the data to support how that looks. And you can't be bouncing back and forth because your data is invalidated. So if that works for you, go for it. It's not going to be something that I do. If volatility changes ATR after entering a trade, it will be worth running size calculation in interval. So to that question, if volatility does expand like this, would it be worth moving around the position? First off, not changing position sizing. If you're in a trade and it's working and then you start peeling off contracts because it's working, that actually we found that is a very bad idea. Think of it this way. If you start peeling off contracts as you're making your biggest wins, you're taking your biggest wins that are going to pay for your losers and shorting them, making them smaller. We did the backtesting a few weeks ago, and we actually found that the only instance of it where it actually makes sense is you remember how silver crashed? Where's silver? Hang on. Silver crashed here. 30% in a day. That was the only instance where it makes sense to pull off contracts as it's going up. And I'm not sure if you can see the future, but I certainly can't. So I'm not going to peel those off because the data actually shows that other than this one circumstance, it doesn't make sense to reduce your size on the way up. Okay. Senior Wahoo, this is going to be our final thing here because we're going to jump into the invitation only live stream immediately after this. Can you look at the doji candle and huge volume on Monsanto and explain the pattern? A, I'm not a pattern guy. B, I don't know if I call this a doji candle. Doji candles are like this. Doji candles are like this dude over here, where it's like really, really, really close to each other. Again, I could be wrong. Somebody, and that's, you know what? That's a perfect example. Perfect example of why I'm not a pattern guy. To me, it's not a doji candle, but to you it is, right? I hate subjectivity, don't you? When's the last time a scientist was like, I think that the chlorophyll looks like this. And another scientist is like, well, I think the chlorophyll looks like that. And a third scientist comes through and he's like, both of you guys are wrong. The chlorophyll looks like an upside down triangle cheesecake staircase pattern. And they're like, oh, yeah, you need to be a data scientist. You need to be a math scientist. And patterns are freaking stupid. But anyways, how would I explain this? A doji candle is for a indecision candle. We've got buyers coming through, we've got sellers coming through, but at the end of the day, they met in the middle, right? We meet in the middle, neath that old Georgia pine. Anyway, the idea here is that this is an indecision candle, and it could mean a reversal. Now, that's kind of what we're seeing here, but I'm not calling for that to happen. Listen, I have so much to do. I'm going on break for a week. Now, if you are an outlier, you need to join us over in the invitation only live stream. And we're going to give away all kinds of fun stuff. So be sure you do that. And if you're not, Outlier's only 82 cents a day. What are you waiting for? And if you're ready to save time, make money, and start winning with less risk, click one of these two videos. We'll talk soon.